Question 1. What is RTGS and NEFT? Answer. RTGS, Real-Time Gross Settlement, NEFT, National Electronic Fund Transfer. These two are the two methods through which funds can be transferred from one bank to another bank. Question 2. What is the cost of debt? Answer. When any company borrows funds from a financial institution, bank, or other resources, the interest paid on that amount is known as cost of debt. Question 3. Types of accounts in banks. Answer. Saving bank account, SBAC. The main purpose of SBAC is to encourage small savings from the public. Interest paid on SBAC is 3%. Any individual can open SBAC. An Indian residing at abroad can open NRIAC. NRI represents non-resident Indians. Current account. It's a running and active account. No interest is paid on current AC. Current accounts can be opened on firm names. Even individuals can also open current a %, but on firm names you cannot open SBAC. Fixed deposit account. Amount is kept for a fixed period. Higher rate of interest will be paid on this AC. Recurring deposit, RDAC. A fixed amount can be deposited in monthly. Question 4. What is prime rate? Answer. Basically, prime rate is the rate of interest that is decided by nations, USA, largest banks for their preferred customers, having a good credit score. Much variable interest depends on the prime rates. For example, the April annual percentage rate on a credit card is 10% plus prime rate, and if the prime rate is 3%, the current April on that credit card would be 13%. Question 5. What are industrial banks? Answer. The main purpose of industrial banks is to provide big loans to large-scale industries. Examples: IDBI Bank, Industrial Bank of India etc. Question 6. What's the Treasury stock method? Answer. The Treasury stock method is used to calculate the net increase in shares outstanding if in the money options and warrants were to be exercised. Question 7. How do you boost returns in an LBO? Answer. The key levers are, a lower purchase price, a higher exit price, when the company is sold on, increased leverage, improving the way the company operations, or getting cheap financing. Question 8. Why should a company prefer equity finance to debt finance? Answer. Equity financing is less risky, you won't have to pay it back, you'll have more cash on hand, you won't have to channel profits into loan repayment, your equity investors will have a longer term view, your company will have more credibility, and you might get to tap your investors' network to help you develop the business. Question 9. What is accretion and dilution? Answer. Accretion is asset growth through addition or expansion. Accretion can occur through a company's internal development or by way of mergers and acquisitions. Dilution is a reduction in earnings per share of stock that occurs when additional shares are issued or the stock changes into convertible securities. Question 10. Define CAPM. Answer. CAPM is the capital asset pricing model, and it is a model designed to find the expected return on an investment and therefore the appropriate discount rate for a company's cash flows. It provides the required rate of return given the riskiness of the asset. Question 11. Name a few poverty eradication schemes of Govt of India. Answer. Food Security Bill, MNREGA, Sarva Shiksha Abhiyan, Antyodaya Yojana, JNNURM, Swavalamban Yojana, Nirmal Gram Yojana, Rajiv Awas Yojana, Indira Gandhi Pension Plan etc. Question 12. What is capital adequacy ratio? What is demat account? Answer. CAR is the proportion of capital to the bank's risk. Demat accounts are those in which shares, securities and insurance policies are kept in electronic form. Question 13. What is inflation and deflation? Answer. Inflation is the increase in the price of goods and services due to more demand and less supply. In inflation, there is more liquidity in market which has to be controlled to reduce the purchasing power of customers. Deflation is the decrease in prices of goods and services due to more supply and very less demand. In deflation, there is lack of liquidity in market which results in very weak purchasing power of people.